Australia property market has always been emotional. But when you step back and look at it through a long-term data-driven lens, a very different picture emerges. Over a 25-year horizon, property investing stops being about short-term affordability debates and starts becoming a question of structural forces that quietly compound over decades. If we strip away from sentiment and focus purely on numbers, demographics, supply constraints, and policy settings, the outlook for Australian property over the next quarter century looks far more resilient than many people expect. To understand where the market could go over the next 25 years, it's important to first look at what has already happened. Over the past 25 years, Australian house prices across most capital cities have increased several 100%. Despite multiple recessions, interest rate cycles, global crisis, and constant warnings that prices had gone too far. Data from industry bodies consistently shows that cities often dismissed as secondary markets have at times outperformed traditional favored locations when measured purely by long-term growth. This historical context matters because it demonstrates that long-term property outcomes are not driven by headlines but by slow-moving structural trends. One of the most powerful of those trends is the relationship between demand and supply. Property prices rise when demands grow faster than housing stock, and they stagnate or fall only when supply overtakes demand. Australia currently faces a structural housing shortage that has been building for years. New dwelling completions have consistently failed to keep pace with population growth, and planning delays, construction constraints, and labor shortages makes it difficult to close that gap quickly. This imbalance is not cyclical, it is structural, which means it tends to persist across decades rather than years. Population growth is a key amplifier of this issue. Australia's population continues to expand through a combination of natural growth and migration, and official projections show the population increasing significantly over the coming decades. Every additional household requires a place to live. Yet, the pipeline of new homes remains constrained. When population growth continues while housing delivery lags, pressure on prices and rents build steadily, even during periods when economic conditions are less favorable. Affordability is often raised as the main argument against long-term price, but the data suggests affordability alone does not cap prices. Over the past 2 decades, dwelling prices have risen much faster than incomes, and yet demand has not collapsed. One reason for that is that the prices are not set by average buyer, but by the marginal buyer, the buyer who is willing and able to pay the highest price. Over time, the composition of that marginal buyer has changed. Dual income household, investors with existing equity, family assisted buyers, and higher income professionals now play a much larger role in setting prices than they did 25 years ago. This shift in the marginal buyer is critical when thinking about the next 25 years. Home ownership is no longer evenly distributed across income groups, and housing is increasingly concentrated among those with access to capital, equity, or family support. As a result, median income statistics become less relevant for predicting price ceilings. Prices do not need to be affordable to everyone. They only need to be affordable to enough buyers competing for a limited number of properties. Credit availability also plays a major role in long-term outcomes. Over the past 25 years, lending markets have become more flexible, with longer long-term roles, a wider range of lenders, and more nuanced assessment of borrowers' income. While lending standards tighten and loosen over cycles, the long-term trend has been towards greater financial sophistication and access to credit for those who qualify. Even modest extensions in loan terms or changes in borrowing structures can significantly increase purchasing power over decades, supporting higher asset prices. Government policy has consistently acted as a backstop for the housing market. First-home buyer incentives, shared equity schemes, low deposit programs, and tax settings have all worked to sustain demand, particularly during periods of stress. While these policies are often framed as affordability measures, their market impact is to increase the number of active buyers without a corresponding increase in supply. Over a 25-year horizon, repeated policy interventions of this nature tend to reinforce price growth rather than restrain it. When long-term projections are models using historical growth ranges rather than extreme assumptions, the numbers become confronting, but not unprecedented. If Australian property were to grow at a rate even materially lower than the last 25 years, median house values in major cities would still be multiples of today's prices by the late 2040s and early 2050s. These outcomes feel unrealistic only because they are compared to today's prices, just as today's prices would have seemed unrealistic to buyers in the early 2000s. Debt dynamics further change how these projections should be interpreted. Over long periods, asset growth can dramatically reduce loan to value ratios. Even if the nominal debt remains largely unchanged, investors who use leverage conservatively and allow time to do the heavy lifting often find the debt becomes less significant relative to the asset value, while equity expands substantially. This is one reason why long-term property investors tend to focus less on short-term price fluctuations and more on holding quality assets through full cycles. None of this suggests that the property markets move in straight lines. Over the next 25 years, Australia will experience downturns, periods of stagnation, policy shifts, and external shocks. Certain markets will underperform, and some locations may struggle due to oversupply, weak local economics, or changing demographics. But the national picture is shaped. Certain markets will underperform, and some locations may struggle due to oversupply, weak local economics, or changing demographics. Investors who focus on locations with long-term demand drivers, constrained supply, and economic relevance are aligning themselves with forces that have shaped Australian property outcomes for generations. When viewed through that lens, the next 25 years look less like a gamble and more like a continuation of patterns that are already deeply embedded in the system. This is Rajan Sharma signing off, CEO of Investor Partner Group. If you have any questions, please feel free to DM me or put your questions in the comments. I'll be more than happy to answer those.